Hello, everyone. Welcome to the Final Bar. Today, it's Monday, May 8th. We'll talk about this market environment, some earnings coming on, but overall, it's all about recovering from this Fed week, all of the activity that we've had. What's next? What's sort of this uncharted phase before the next Fed meeting, this quiet period, but not so quiet for certain areas of the market. Ladies and gentlemen, this is the Final Bar. Hello, everyone. Welcome to the Final Bar. I'm your host, Dave Keller. I'm the Chief Market Strategist here at StockCharts.com in a sunny Redmond, Washington. Thanks for joining us every weekday after the close as we break down the activity in the markets using the power of StockCharts. The StockCharts platform was really designed to empower individual investors to better understand the markets and make better decisions. Now we have financial advisors, plenty of individual investors, institutional investors, many others using our platform to try to make sense of these markets. And what's great about the technical toolkit is it's designed to cut through all the noise, all the unknowns, all the uncertainty. Charts tell you not what should happen or what could happen, but what actually is happening by focusing on supply and demand, fear and greed, all those emotional pushes and pulls that cause investors to make decisions. What we like to do on the show is try to make sense of things by using the language of technical analysis. And let's get to our market recap. Let's break down what the charts are telling us today. When we look at the major averages, essentially unchanged, to be honest with you. When we're looking at the S&P 500, the NASDAQ, you can see that the S&P's essentially flat from yesterday. The NASDAQ up just a little bit, but not much. The Dow down just a touch. So overall, really a choppy sideways period. There's no real direction, I would say, at the end of the day. Little blips through the course of the day. In early afternoon, around 2 p.m., you saw a drop a little bit in the S&P, but at the end, kind of netting out to a flat market. Mid caps and small caps, however, moving lower. And I think it's worth noting you continue to see this dispersion between small caps struggling and large and mega caps kind of hanging in there. That gap continuing to widen on a day like today with the small cap index underperforming. The VIX is actually moving back lower, and that was one of the things we talked about last week with my guest T.G. Watkins. I think during charting forward, we talked about that a little bit as well. But we're in sort of this low volatility environment. The VIX just narrowly last week pushed above 20, but back down to 17 now, down just a little bit from yesterday's close, from Friday's close as well. Looking at some other asset classes, you can see the yield curve overall pushing higher today from the short end to the long end, but very much exaggerated in the longer end of the curve. 5-year yields around 3.5%, 10-year yield around 3.52, and long bond yields around 3.84. And you can see that interest rates sort of pushed higher through the course of the day today. No real change for the dollar index, to be honest with you. Similar to stocks, sort of a choppy sideways day. Gold and silver ended up flat as well. Gold and silver prices, gold in particular, had been stronger earlier in the day, but settled down to finish not too far from where we finished Friday's session, which was a nice up day for precious metals all around. Crude oil prices pushing a little bit higher today, along with copper prices. And you can see that the DBC, which is a broad commodity ETF, finished up about 0.5%. Cryptocurrencies all in the red. Had some buzz about regulatory challenges for cryptocurrencies, which I feel like is sort of a chronic challenge, a chronic headwind for the cryptocurrency trade. Is can we, continue to grow and have this new asset class thrive in the face of regulatory uncertainty, right? Will there be additional regulations put on these? Will they be, will regulators attempt to do something different and centralize in some way this decentralized exchange? And for now, you're seeing prices net out negative. Ether down about 2%, Bitcoin down about 3.5% from yesterday's close. You can see the deterioration really happened during the day yesterday. That's on Sunday over the weekend, and then pushing lower through the course of the day today. Bitcoin, as you can note, down to around 27,500. We've talked about 30,000 as that big round number. We teased those levels, we tested those levels, but really we're unable to power above them. Let's look at a daily chart of the S&P and just see where things are at right now after today's session. So you have what we call a doji candle, which is where the open and close are kind of along the same level. Again, no real change from Friday's close as well. And so what that does is it sort of keeps us in the range we've been talking about here, right? Going back to the beginning of April, the S&P's essentially been choppy sideways, and this is right up where we were retesting the highs from February, sort of that 41 to 4,200 range. We have the green horizontal line right around 4,200. You'll remember last week we talked about this shooting star candle, which happened when we opened, traded right up to 4,200, but then closed back lower. So after that, we're sort of still sideways choppy in this, I guess, this wilderness between 4,100 on the lower end and really the 50-day moving average, not too far below us, just below 40.50. Then on the upper end, we have this 4,200 level. We first established that as a level of resistance in February of this year. We retested it a couple weeks ago, a week and a half ago, and now all of a sudden, once again, we're in this range. So one of two things most likely happens. Either we power above 4,200, which I think all of a sudden opens doors to all sorts of interesting possibilities above that level, but we have to cross that first, right? On the other side, do we trade down to the 4,100 level? Do we trade a little bit below there to the 50-day moving average? And if a level like that doesn't hold, then I think you really have to start thinking about the potential for further deterioration, further downside for the major averages. For now, I would argue we're still in that holding pattern between those two extremes. What's interesting is we've sort of gotten through the meat of earnings season. We have a couple little ones, and they're not that little, right? You have some energy names like DVN after the close, semiconductors like Skyworks come to mind, PayPal. So a number of obviously names with quite a wide following and potential to move. However, are they big enough to really create some climactic change like we had when a FAANG stock is reporting earnings? Not as much. We sort of don't have that particularly this week. So we're left with what causes the market to move higher. We do have inflation data coming out through later this week with CPI, PPI numbers as well. Those might be the next big numbers to pay attention to and to prepare for. Can we look at the chart of Bitcoin here very briefly and just see what's happened? As I mentioned, we were trading up to resistance, stalling out here, and the daily chart of Bitcoin looks a little more concerning to me than just looking at the daily movements. We dropped quite a bit today. You can see that in today's candle, down about 3.5+%. But if you look at what's happened over the last 6 to 8 weeks, it's a little more concerning, right? Bitcoin making higher highs into March, higher highs in April. All of a sudden, we've stopped making higher highs. And for now, we've stalled out at 30,000. That big round number we talked about for quite some time, thinking, all right, if we rally, next upside objective, probably around 30,000. Big round number. We did hit that as resistance in mid-April. We pulled back. Now we've tested it a couple more times and have failed to get above there. So this is the kind of chart where it's sort of bullish up to 30,000, and then it's the question mark, right? Do we have enough upside momentum to power through there, or do we stall out? And for now, we haven't really been able to power through there. Is it breaking down or going a lot lower? Certainly not. Now we're really close to the most recent swing low. That's right around 27,000. We have gotten briefly below the 50-day moving average, which is something to watch. The question is, do we get below 27,000? So for now, it's sort of 30,000 on the upper end, 27,000 on the lower end. Which way breaks? Which way does this resolve? The short-term weakness tells me to pay attention to 27,000. The RSI is right down to around 40. Which is a potentially concerning level. So let's look through the remainder of this week to see if that level is able to hold. If not, then we'll have to start talking about some further retracements to the downside. Let's look elsewhere, actually, at the sector returns, because I didn't mention that a little bit before. Only two sectors really in the green, meaningfully enough. The communication services sector up about 1%. Consumer discretionary, the XLY, up about 1/3%. Financials and energy, as well as technology, about flat for the day. No real change. On the downside, couple sectors underperforming, particularly real estate, down about 2/3%, followed by industrials, materials, utilities, consumer staples, all around 1/3% lower. So again, no significant moves. It's sort of a quieter session is the way I would describe it. So let's talk about some of the movements to pay attention to, some of the movements to look for. PayPal reporting earnings after the close today. Let's talk about what the setup is, excuse me, from a technical perspective, looking back at the last 2 to 3 years. So if we look back at the last 2 years, we can see obviously PayPal is at the lower end of the range. Now, obviously the stock sold off significantly in the second half of 2021. That continued through pretty much all of 2022. Then the stock has sort of found its footing, but never really recovered, right? There's a difference between starting to go up and just stopping going down, which is how I would describe PayPal. But if we look at the last 1 year, zoom in a little bit, we can see some of the contours here, and we can see that the stock has found support right around $72 a share. That's a little bit above the low in December of last year, which was sort of the low for now. That was around $68 a share. We bounced up to the mid 80s and then traded back lower. And now once again, we found this floor around 72. Heading into an earnings release with this sort of framework, I'm immediately drawing a line right around 72. I'm setting a price alert. As long as we hold that, things aren't getting worse, right? If they would have a negative earnings report for some reason, if we can hold 72, things are still kind of the same. Things holding in there okay. There's certainly a potential to surprise to the upside. I think getting above 78, breaking out of this range could be encouraging, but we're sort of range bound right now, and I'm more concerned with the potential areas of support and making sure that they hold. Now we look after market today for now, trading up a little bit, about 0.4% higher. It's just below 76. We're sort of right in that range, still in the range of today's trading. So something certainly to watch going through the remainder of this week to see if you get additional upside from PayPal. PayPal is one of those names that sort of the bull market forgot, right? Just really hasn't participated to the upside in any significant way. Let's look at a chart of Netflix. This is one I was doing my normal weekend routine, which is going through the 500 stocks in the S&P 500 one by one, looking at all their charts. It doesn't take me that long, but it's a really important exercise for me because it's just a way to make sure that I see every one of those charts at least once a week and just focus on what I can take away for it. And what jumped off the page on the chart of Netflix is what I will call a potential head and shoulders top. And the word potential is really important there. And what I mean by that is this. If you look at the trading in, sorry, I don't mean to make it so significantly bright pink and like I'm shouting at you with the trend line. Here we go. So if you take the high in February, lower high in December, lower high in March to April, certainly looks like an inverted, a head and shoulders top, which is a high surrounded by two lower highs. Here's the kicker, though. You have to break the neckline, which is the interim lows from December and from March, to complete that head and shoulders top and to complete a rotation to the downside. We're actually bouncing higher a little bit today. Stock was up about 2.5%. So we're not near that neckline just yet. Until that neckline is broken, this is a potential head and shoulders top. Breaking that neckline is a concern. What's interesting is, and one of my mentors among many was Mike Epstein. And Mike Epstein was a longtime broker. He spent time at MIT working with Professor Andrew Lo at the later stage of his career. And that's where I first met him when he was sort of toward the end of his career. Unfortunately, passed away a number of years ago. But he used to say the most bullish thing is a failed head and shoulders top. And to show you a perfect example of that here to finish things off, I will go to my historical chart gallery, which is this one. I have one that says S&P 2007 to 2010. Maybe that's it. Nope, that's not it. It's one of these. Let's see, 2007 market top. Oh boy, I'm not going to be able to find it. What I'm going to attempt to show you here is there are times, here we go. Phil, I was going to say, I know I have a chart that says this exact thing. This is what I first talked to Mike about this pattern. This is the S&P out of the 2009 low. You can see we rallied through the remainder of this year, then made this potential head and shoulders top. And my chat on Bloomberg at the time was lighting up with people talking about the market topping out because it was an obvious head and shoulders top. Mike's comment to me was, until we break the neckline, it's nothing but a potential head and shoulders topping pattern. If you look, we broke right back to the upside, and it was one of my great moments of connecting with an expert like Mike, was seeing that sort of analysis, how he really thought about the discipline and how to wait for the right trigger. So for now, a chart like Netflix, not looking too bad. Folks, let's take a quick commercial break. We'll be back answering some of your questions from the Final Bar mailbag. We'll see you in a minute. Hey everyone, welcome back to the Final Bar. This is Dave Keller here at StockCharts.com. Thank you so much for joining us every weekday after the close for our show. Couple quick announcements before we continue things on today. First off, we welcome your questions. We're going to do a mailbag segment a little later in today's show, and that's fueled from viewers like you sending in your questions. Email us, won't you, at thefinalbar@stockcharts.com. We're on Twitter at FinalBarSCTV. And we're on YouTube. Put a comment below the video you're watching on our StockCharts YouTube channel. We hope to hear from you and answer your question live on our next mailbag, which will be Friday's show of this week. Upcoming schedule tomorrow on Tuesday the 9th, I have Jay Woods of Freedom Capital Markets joining us from New York. On Wednesday the 10th, Frank Capillari, founder of Cap Thesis, longtime sell-side technical analyst. Then on Thursday, May 11th, we have Clint Cowles, who's a regional strategist at TD Ameritrade. Also, just to remind you, Charting Forward, which is our second quarter market outlook, just aired earlier today on StockCharts TV. You can find the replay at stockchartstv.com or on our YouTube channel. Great discussion here from the studio about all the things we are seeing and hearing. You don't want to miss that lively discussion. Let's continue on with the final bar mailbag. Thanks for all the great questions you've sent to us. Here is question number 1. Dave, in your market trend model, what is the rationale of using EMA or exponential moving averages versus simple moving averages for the long-term averages? And you had a lot in your question talking about some of the different nuances and why you may want to select simple and versus exponential averages. You asked about the periods as well, 5-week and 13-week. So here's what I will tell you. My general way of thinking about simple averages versus exponential averages is this. The benefit of looking at simple averages, which is why when I bring up a stock like Home Depot, I have the 50 and 200-day moving averages on there, is because I've spent a lot of time with a lot of different institutional investors all over the world. And I will tell you many of them, even if they're not big chart people, they seem to know where the 200-day moving average is because so many trading desks look at it. Anyone that is technically oriented certainly understands the meaningful or the meaning of the 200-day and subsequently the 50-day moving average. So watching the 50 and 200-day, in my opinion, is sort of like seeing what other people are seeing as they're evaluating a stock. And I think there's some value to that. I think it's important to know, and I like getting inside the head of other investors and knowing what sort of data points they're going to be looking at. That's, I think, one of the great values of it. Is the 200-day moving average the best way statistically to take an average of price movements? Absolutely not. And that's why exponential moving averages, if I was designing any sort of trading system, if I was designing a trend model, which is what we're looking at here, my weekly market trend model, I would use exponential averages. That's why I'd use them. Now, you have to be careful because you asked about things like the 5 and the 13, the 1 and the 5, the 21 and 34. What you have to remember with exponential averages is it's not exactly just a 5-week or 5-period moving average, meaning you add the last 5 observations and do something with it. An exponential calculation is a little more complicated than that because it's weighting the most recent observation a certain percentage. I actually talked about this a little bit on a show last week. It might have been on the mailbag on Friday, but I would encourage you, if you go to the little magnifying glass on StockCharts, type exponential moving averages or type RSI, the relative strength index, which is driven by exponential averages, you'll see the calculation and why the day count is kind of a weird way that we've I guess become accustomed. It's sort of the culture. This is the tradition to use it in terms of day counts. It's not the most accurate way to really represent what an exponential average is doing. Having said that, the reason why I do these particular settings, the 5-day or 5-week, 13-week, 21-week, 34-week exponential averages, is from a lot of back testing earlier on when I was first coming up with a market trend model. And what I was doing every week is looking at the chart and just saying, here's the short-term trend, medium-term trend, and long-term trend. I would just do it visually. What I wanted to do was come up with a series of moving averages that would be very, very close to what I was doing subjectively by just looking at a bunch of charts. And I found this combination worked very, very well for me. So this may not be the sweet spot, perfect combination for you, but it certainly helped me and was a great time saver in being able to look at a lot of different things using this market trend model and think about the timeframes that were important to me. So that is why exponential averages are important. That is why I selected those. By the way, if you want more information on my market trend model, go to my YouTube channel, which is called Market Misbehavior. There's a video called The Most Important Chart Every Day, and it talks about this particular model and how and why I designed it. Thanks for that question, by the way. Next question, looking at the long-term trend, is this a short-term market downturn or the start of something new? And I love that question. There's an honesty to that question, which is just what's coming. So I would love to tell you I know the answer. What you have to remember, my first big disclaimer is I don't know. And anyone that tells you they do know is lying to you or lying to themselves, or maybe a little bit of both. We want to think that we know what's going to happen. The best I can do is look at market history, look at market dynamics, and give you an educated guess as to what's most likely going to come next based on the combination of factors and indicators and price action that I can see. That's the best we can do as financial analysts in any discipline, but particularly with technical analysis. That's what we're doing, is try to analyze market history to uncover some ideas about what may come next. You were asking this question during this period here, which is obviously pretty choppy. We had the Fed meeting with the rate hike last week, and the question is, if the Fed is done raising rates, which I think they are, but again, they could surprise us for sure. And I would say they've said they're data dependent so much that if things would get really wonky, all of a sudden the inflation data this week would spike higher, and all of a sudden we get people really nervous, and all of a sudden you see signs of further inflationary pressures. I wouldn't be surprised if we start hearing language about the fact that the Fed may consider raising rates again, but I think they're most likely done because we've had such an impact from rate hikes, particularly with financial institutions, that were probably an unintended consequence of a rate hike. So the question is this a short-term market downturn or the start of something new? I would tell you that the chart is the best thing to watch to determine whether that's not the case. What's really funny is it's not funny, but it's true. Every big loss, right? A huge loss starts as a small loss, right? Before something can go down 50%, it first has to go down 10%, 20%, 30% all along the way. Now, granted, stocks and ETFs certainly can have big gaps where they have changes overnight. When we're talking about the major averages, it's pretty unusual for you to have some significant move without some signals along the way that things are changing. That is why now we're talking about things like, is the S&P stalled out and no longer making new highs? I think that's one cause for concern, right? We're not going down necessarily, we're just not going up anymore. If we would roll over, right, do we find support at levels where you might expect support? Do we find support at the 200-day or not? Do we find support at 3,800 or not, right? So sort of those lines in the sand that define your risk. And if we hold those, things are okay. If we would break through those, then maybe things are a little more concerning. Those are some of the things I would look at. For now, the things that concern me are breadth conditions deteriorating, and just the fact that things are approaching resistance, at a resistance, but not really following through too much to the upside, with limited exceptions. Right, there are some stocks that are certainly doing just fine, but the average stock has been struggling. I would want to see those things improve before I would feel a lot more optimistic about the upside there. I think we'll probably have more backing and filling just based on the fact that we're in a seasonally weaker part of the year. And that's maybe another thing to think about, the seasonal tendencies, which are not particularly encouraging May, June, July for sure. Great question, by the way, and thanks so much for asking about that. Next question, what should we think about Friday's low volume? And I really appreciate you sent a screenshot of a page you were looking at. I don't know the source of it, so I didn't want to share it here, but you're basically talking about the S&P 500, the volume characteristics, and on Friday, it looked, I think the screenshot you sent me was Friday, the S&P's volume was about 15% below Thursday's volume. So I'm showing you my chart of the S&P 500 with volume and on-balance volume on here. Now, sorry about the shaded areas. We're kind of looking at a bunch of different things here at the moment. But what we're looking at here is the volume red and black histogram here at the bottom. That's the daily volume reading on the S&P 500. This is on-balance volume, which is Joe Granville's kind of improvement on daily volume readings, just trying to track volume trends over time by comparing the volume movement with the price movement itself. If you look at what's happened, you were actually talking about this particular gap, which is the volume on Friday is about 15% lower than the volume on Thursday. I would personally attribute very little to that. I would say day-to-day volume readings, it's hard to draw a big cause and effect conclusion, in my opinion, from that, unless it's a huge volume spike, right? Double the normal volume, something unusual is happening. That's an earnings release, that's a big news flow day, that's the Fed, something's happening to cause some significant shift in volume. But if we're just talking about these little shifts in here, I don't know if day-to-day changes in volume are as much to interpret on the time frame I'm thinking of, right? If you're a day trader or a swing trader, maybe. But for me, thinking a little bit longer term, not so meaningful. What is meaningful is the trend in volume, and that's why indicators like on balance volume, we talked last week about things like Chaikin money flow, the accumulation distribution line. I think those are all continued improvements on this idea of looking at volume trends over time. One of the causes of concern, I would say, for the S&P is you really haven't had a significant move higher on heavier volume, which is what is usually sort of the basic tenet of a bull market phase, is the market trending higher and the volume trending higher as well. We've seen an increase in volume over the last couple weeks, really going from early early April to late April, but the market arguably has been more sideways than anything. So I don't know if I could draw any big conclusions from that particular dynamic yet. Next question, should Tesla be included in the FAANG stock group? The FAANG is what you asked about. So yes and no, right? Should it be included in the FAANGs? Probably not, because I would argue that, when I'm looking at the, Meta, Alphabet, Apple, Netflix, Amazon, these are stocks overall that have actually held on pretty well. And I think that group of mega cap names has done pretty well. I have this list of stocks called the Phenomena stocks, which adds things like Adobe and NVIDIA, others that are kind of FAANG-like, but not exactly in there. Now, there's an index called the New York FAANG Plus Index. I will tell you that they actually do include things like Tesla, I believe. I don't really remember what all is in there at the moment. Twitter, I remember seeing was in there. Some of the Chinese internet stocks were in that index. I don't have a lot of clarity in terms of what all is in the index at the moment. But I will tell you that that's sort of like FAANG and FAANG-like stocks, which is why it's called the New York FAANG Plus Index. Having said that, I think looking at key names like that and thinking about the implications of the mega cap stocks, absolutely. So if I were to add another name or two, Tesla might be it. The only reason why I probably wouldn't is because if you look at the chart of Tesla versus any of those other ones, it's sort of diversifies, right? It's sort of a very different pattern than the average FAANG stock that we've seen over the last 12 months. For that reason, I probably not want to include it. But your point is a good one, which is pay attention to the mega cap stocks. I would certainly be keeping an eye on Tesla and all those others that are big weights in some of those sector ETFs. We have to wrap the show and go to the 3 and 3, 3 charts in 3 minutes that tell the story of this market environment. Here's chart number 1. When I'm looking at the Russell 2000 ETF over the weekend, I was looking at a bunch of different charts, doing my report for my premium members of Market Misbehavior. One of the things I was looking at was the Russell 2000. If you look at the last 12 months on the Russell 2000, the way to do that on StockCharts, best way is IWM, which is the Russell 2000 ETF. If you look, it's just incredibly sideways, right? Imagine this over the last 12 months. Small caps are at the exact same level they were back in May of 2022. With all the volatility, with all the movement, we're almost mid-range from where we've been over the last 12 months. So when we talk about the S&P and the NASDAQ testing new swing highs, testing 41, 4,200, you have to remember that something like the small cap index is much more of an obvious bull market tell. It's more of a choppy sideways unknown tell. What's interesting about the chart of the Russell 2000, by the way, is we are recently bouncing off of support. So while the S&P is testing resistance, the Russell 2000 is actually bouncing off of a fairly consistent support level, which is around 170 on the IWM. I am eyeing this level in a big way because if and when prices would go below there, boy, talk about a vote of no confidence in a bull market phase. Small caps struggling, not just not participating in an upswing, but failing to be a part of the story at all. Russell 2000 ETF, I think an important chart to watch this week for sure. You know, think about other charts that are looking a lot different than that. AMD, Advanced Micro Devices, is a good example. This is one of the better charted or better, looking semiconductor stocks at the moment in terms of the overall trend, right? This just nice, clean bull phase of higher highs and higher lows off of the low in October of 2022. Look at the higher highs in November of last year, in February, a clear higher high in March, and now putting in what appears to be a higher low and now rotating to the upside, up and almost 6% again today. So while the move higher in AMD over the last week is encouraging, I'm much more encouraged by the fact that the trend is clearly positive. So just like with the Russell 2000, certainly looks like the absence of trend or the absence of a bull phase of any sort. On the chart of AMT, I think you're seeing a very clear bull phase, right? Higher highs, higher lows, getting above moving average support and holding it. As long as that pattern continues, a chart like AMD is not in a bad shape at all. Finally, airlines. I put this big, thick pink trend line just to show the trend that we've seen in airlines. AAL was on the top 10 S&P gainers list today, gapping up about 3.5%, gapping above the 200-day moving average. That's not a bad thing. I don't think that's bad at all. But let's put it into historical perspective. I will tell you the same thing about energy stocks rallying off of a very weak level when we talked about them last week. There's upside to be had for sure, but I think these charts have a lot more to prove before they turn into more of a bullish phase. What would you need to see on this chart of American Airlines to be a complete rotation back to a clear bullish phase? A higher low would be good. Getting above this trend line, getting above swing highs, those are all the things that confirm a new uptrend. We're not seeing it yet on a lot of the airlines charts. Folks, that's a wrap for the show. Thanks so much for joining us every weekday after the close for the final bar. All of our previous interviews are at StockChartsTV.com. For StockCharts in Redmond, Washington, I'm Dave Keller. Have a good night.